Welcome to NREI's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at NREIOnline.com. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. Good afternoon, David. How are you?
I'm doing well. How are you doing today?
Doing fantastic. I know that we are going to introduce the audience to kind of a new format for this show. You want to explain what's going on?
Yeah, so up to this point, we've been doing a lot of weekly shows with a lot of recapping several stories, a lot of highlights from each of our week's coverage. We're going to shift to doing an every other week format going forward. So podcasts will be hitting your inboxes every 2 weeks instead of every week. And we're going to try some more, rather than just kind of doing news highlights, want to try to have slightly more in-depth conversations on, big issues or stories within the sector. And so that's the idea.
All right, trimming down the amount of news, maybe I know we're going to do one story today. Maybe some of the podcasts will be one or two stories together. But so we'll dive a little deeper. So I'm pretty excited about that. And I know today we're talking about Mickey D's, right?
Yes.
All right. So what's so important about Mickey D's that we're spending a podcast talking about?
So it's not necessarily the newest idea, but I think it's an idea that's being brought up again. But this concept that, at its heart, McDonald's is not really a burger company. It's a real estate company. And so unpacking what that means and talking a bit about why that's kind of coming up again.
Got it. All right. Yeah. So it's I've heard that before. I don't know much about it, but I've heard before that they are almost more of a real estate company than they are a fast food restaurant. And I think they're one of the few in the United States, at least, that could be considered that. Is that right?
That's right. And basically, I mean, if you look at their portfolio overall, they own a tremendous amount of the real estate of all the McDonald's in the United States and, in fact, globally. When you see McDonald's, so for a lot of chain restaurants, what you're often seeing, especially franchise spaces, is there could be any number of arrangements. It could be a third party that owns the site, and then the franchisor is renting the space, and then also has their franchise agreement with Subway or whoever. Mm-hmm. In McDonald's case, they actually own a tremendous amount of the real estate. And I think the current value of that globally is $34 billion.
Wow.
So that makes them one of the largest real estate companies in the world when you look at that number. And the question that often gets raised, I think if this comes up like every maybe 3 or 4 years, is especially like when McDonald's may be having some choppiness in its sales numbers, they may be having some operational revenue questions. Often people will look back at that real estate line and then be like, well, why don't, and which is always rock solid, because the way that they structure this thing is since they own the real estate, their agreements with their franchisors are often that person is renting the space from McDonald's and also has the franchise agreement. So it's kind of like a dual contract situation. Mm-hmm. And then if you look at those two different revenue streams, the rental stream is often more consistent. It's more locked in, and it's not as dependent on the operational, things that may be affecting operations, things that may be affecting sales. So there's often this idea that gets raised of, why don't you split those into two different companies and have a McDonald's real estate company, and then you have your McDonald's franchise company, and have a kind of clear, two different sort of more clarified operational structures, have something that's a little bit clearer for investors. They can choose to invest in one or the other or both, and and maybe try to unlock some value that way too.
So you said it comes up every 3 or 4 years, right? So what's been the problem so far? Is it just not a good idea, and there's just a few people that are thinking it might be, and they just get voted down, or what?
Yeah, I think it's kind of that. I think at the end of the day, it's something that makes, they consider it, and if the management is often just come back with the idea that no, it doesn't make sense to do that. like that at the end of the day, we want those two things connected. That splitting the real estate and the operations and the franchisor is not something they want to do. And it may sound so. I think it's like this idea that a lot of third-party analysts or investors think will be a great idea. Because the other potential benefit of doing that is by rolling the real estate into a real estate investment trust. You're dealing with an entirely different tax structure than they currently have right now. REITs don't pay the same kinds of. They have a different corporate tax rate. They have a different corporate tax structure. So like there's some gains that they would have there, give them some flexibility around when they sell their real estate. But I think at the end of the day, the company just kind of would rather not those things be separated. And also it doesn't consider any potential tax advantages that they would get from a REIT structure to outweigh the overall benefit that they enjoy from having that be one holistic company at this point.
Yeah, and I don't know. I think splitting it into two companies puts it in a weird position, because what if you have the heads of those two companies kind of looking in different directions, right? Yeah. I don't know. I mean, as the real estate market fluctuates, all of a sudden, the folks that are running the real estate side of things are thinking, well, we need to do A, B, and C, where that doesn't work well with the franchise side. And yeah, I think that would cause a lot of problems, but that's just my opinion.
Yeah, I mean, it could raise some issue. It could raise problems, because what if, I don't know, or problem, challenge, conflict. Yeah, if on the real estate side, what if you decide the best use of that space is actually not to be McDonald's?
Mm-hmm,
it could
exactly.
be, that could be a pad. Oh, maybe we want that to be a bank instead, which then does that come into conflict with as a company with a certain site selection strategy and looking for a certain distribution of stores. McDonald's, maybe looking for a certain saturation for like how many restaurants they want in each state or each market, and certain distances from each other. I mean, there's a whole lot of refinement that over the years that they've put into that strategy of like, not just granting franchises willy-nilly, but having, and I think all of these massive chain operators try to do that. I mean, there's always some churn. There's always, not every decision will be 100% correct, but overall it's like they've worked. There's been a lot of refinement, evolution in the last 10, 20 years around those kind of portfolio strategies, and which may also mean by like, okay, we want to have a certain number of locations per population density, and even if that means maybe certain locations don't perform as well, it's just part of this overall having the presence, being ubiquitous. Some locations are going to outperform others. And then maybe you have some tolerance for some weaker performing ones, that if you're not considering it from that sort of perspective, if you're just like, okay, we're going to want to look at the real estate and what's the highest and best use of this real estate, there could be a conflict.
Oh man, can you imagine? Can you imagine if that vegetable Whopper took off? Like it just does super, super well, right? Just crushes the market, and all of a sudden Burger King's trying to buy up a bunch of properties, and the real estate guys are like, "Hey, this is a good deal. We should sell these spots to Burger King."
Yeah,
talk about family drama,
right?
Yeah, man. Yeah, that would be. By the way, have you had that burger?
I have not tried not the Burger King version of it. I've had some of those Beyond Burger and Impossible Burger or whatever. I forget what all these cool names.
Yeah, Burger King does Impossible Whopper, I think, or
Impossible
not
Whopper.
a Whopper or whatever they call it. But yeah, I've tried it, and
you have.
Yeah, it's tasty. I'll be honest, it's tasty. It's not a Whopper, but it is actually pretty doggone tasty. So
yeah,
I don't know if that is going to push me to switch. I like a good Whopper. I like a good Big Mac. I like meat. Well, actually, not so much Big Mac. The quarter pounder. No, that's where it's at. But anyway, got off on a tangent. But yeah, I mean.
But I mean, I think that's valid.
yeah. But it would be funny, because we would see all sorts of drama, I'm sure. But I wouldn't have to be involved in it. So it's funny for me, but heartbreaking for somebody else, I'm sure.
Right. But if you get back to the idea that like, okay, if McDonald's as a burger company, not as a real estate company, what is the space like now? You're not just competing with Burger King, but then you have some of these higher, whatever, like I forget what the catchphrases for them, but like the Shake Shacks of the world that are emerging, and Five Guys, some of these higher quality burgers that are also competing and making a dent in that traditional business line. So, that's again a potential conflict if these were actually two different managements and whatnot.
Yeah. I mean, I just don't think it's a good idea. I think we've definitely covered that. What else? I mean, is there any other good reason that they should be thinking about making changes like that?
I mean, the other thing that I think about when I think about this sort of business model of separating the real estate operations from the retail I mean, one, Sears did a similar thing, but I think they were in a very different fundamental business situation when they did it. Just because we've talked about them, their main line of their retail is struggling so hard, whereas they were sitting on a lot of high value real estate or a lot of spaces that were leased at below market rates. They had a ton of value that they could unlock. They also sat on a lot of land that could be developed from their, just from their time there was a time where Sears was actually a developer too, and they still had land or they still owned rights to land. So for them, they did split the company. They did create a real estate company, and that's been a lot more successful in some ways from the retailer. But in that case, it's like a really terrible, not to be too harsh, but a really struggling retailer from a lot of really high potential value to be unlocked by separating the real estate. I don't think we're looking at the same kind of. So there are, so that's one other example of something like this happening. But I think the fundamentals in both the retail operations side and the real estate side are very, very different than what we're looking at with McDonald's. The other thing I think about is the hotel sector, because that's another sector where a lot of the companies are structured like this, where the hotel brands, the franchises are entirely separate companies from the franchisors, and then also the real estate may be owned by a third party. So, and again, there are also plenty of other quick service chains that don't own their real estate. So it would just be like the idea of McDonald's becoming more like what Subway does. So it's certainly not like the craziest idea in the world or unprecedented for, there are franchise businesses that don't own the real estate. There are other sectors where these things are, management and franchise and real estate are all different, distinct entities. So that where like this concept, isn't the craziest thing for McDonald's to think about. But I think at the end of the day, I think that their reasons for not doing it make more sense to me than the reasons to do it.
Yeah, and what I find interesting is that, I've got some notes that you sent me ahead of time about what we would be talking about, and obviously you're bringing the heavy guns to the conversation. But as I was going through this earlier before the podcast, I noticed a quote. Right, it was a quote by, I believe it was the original CEO of McDonald's, and I'm trying to find his name and where it was in the article itself. But I was so surprised because he said it way back then that they're a real estate company. I believe it was the reason we sell 15-cent burgers is because of the real estate part of the company.
Right.
So I don't know what year that was. I don't think the article necessarily quoted what year that guy was the CEO, but 15-cent burgers, that's got to be back in the 50s or 60s.
Right.
Easy. So it's not like this is hey, we've just come onto this idea in the last 20, 30 years, and this has been great. It's probably pretty much been from day one. And I didn't see the movie. I can't remember, The Brothers or something.
The Founder,
yeah. I didn't see the movie, so I don't know if it addressed any of this or addressed this idea. Now it makes me want to go see it now that we're talking about it in the article here. But yeah, there it is. The only reason we sell 15-cent burgers is because they are the greatest producer of revenue from which our tenants can pay us rent.
Right.
Right. Well, there you go.
Yeah, which would then get at the, like you were raising earlier, like, okay, well, if there is another chain that can raise revenue more efficiently in that use of space, or another concept entirely, then like, why we should lease it to them. So like in which case, like, that's the one of the potential contradictions. And that movie is very good. The Founder is very good. It does come up there. We embedded even the clip from the movie in the article we posted, where the revelation is passed along to the CEO. It's probably dramatized for Hollywood purposes, but where this kind of accountant guy sort of like the company's struggling a little bit as they're exploding in growth, and he's like, dude, you're not, the reason you're struggling is because you don't understand what business you're in. You're not in the burger business, you're in the real estate business. So that's in the movie, but it's a good movie. Michael Keaton does a really good job in that one.
Yeah, no, I'll have to take a look at it, because again, you couldn't have this, right? I mean, the franchise side could not help decide what things are going to cost to help, the owners pay rent, right? If they're not involved, if you separate the two companies, real estate's just going to be looking for their rent. Franchise may say, hey, we need to make more revenue on this side, so we're going to up the price, which means they can't pay as much in rent or whatever. I think the communication would just fail.
Yeah.
So, yeah. All right. What else do we need to know about this article specifically?
No, I think I think that's the heart of it. I think I find this to be, like I said, it's an interesting topic that does come up again and again. And I think people are always very fascinated about the idea of like McREIT, coming around so they could buy their, it would be, if they ever did do it, it would, I'm sure, get a lot of investor interest. And I think a lot of retail investors would have a very REITs that specialize in properties that are net leased the way that a McDonald's would be, do very well. So a McDonald's REIT would certainly, I think, get a lot of investor interest and would perform very well. So it's a very tantalizing idea to a lot of people, especially the people that would make money from advising on doing a REIT IPO and those kind of things too. So you always have to think about, that's where some of these ideas are coming from as well. The people that would certainly benefit from this kind of a transaction. But, so it's a fun exercise. It's a fun story. It's, but at the end of the day, the way that they're doing things is, I think, making sense.
Yeah. I one more thing that was in the article is that there was a quote from Pete Benson, which the company's chief administrative officer, and that was back in 2015. I'm not going to say the quote. People can go to the website and take a look at the full article. But because of that, because of the discussion back then, they had estimated, and this is what kind of blows my mind, and maybe you have a comment about this. This is, by some estimates, McDonald's REIT would have unlocked about $20 billion in value, and that was in 2015.
Right.
That's a huge amount. So, I mean, I understand why people might be trying to push for it and say, hey, this is a good idea, because, unlocking $20 billion in value seems like a good idea. However, I think there's a lot of that drawback too.
Yeah. Yeah. And 2015 was the last time this conversation came up. So like I said, it is basically like every 4 years.
All right. Yeah.
I think that was also the last time McDonald's changed CEOs. So there's sort of a calendar to this, new executives. Oh, new leadership. Maybe you should think about this idea, which the last leadership already rejected.
Yeah, so. Exactly. They just keep pulling out the same binder, man. Hey, I'm not rewriting this report. Just look at it, would you?
Right. Just change the cover page.
Yeah, exactly. And the date. That's right.
Maybe change the valuations a little bit.
Just bump the numbers. There you go. That's what people are doing, right? Oh my goodness. Yeah. All righty. Do you have any teasers of what other articles are on the site this week?
Some other stuff that we've covered recently. We also have a big piece looking at Walgreens, and recently the idea has been raised of Walgreens going private again, which is again another one of these stories that they were private. They were taken private in 2012. They became public again in 2017. Now suddenly they're talking about going private again. So what that means, so that story and what that means for the real estate, Walgreens real estate. So that's a big one for people to look at. Yeah. And then some other recent pieces. We had a fun gallery looking at another one of these, ones that we do based on a third-party report. But this one was about 25 dynamic American cities. So we did a whole gallery showcasing some of their metrics on that. And then, just some other pieces on the big merger that's been proposed merger between Prologis and one of their competitors. So there's been some big stories in addition to just some of the day-to-day stuff. But those are some highlights that I think people would enjoy.
Yeah, fantastic. And if you are any of those piqued your interest, get to the website, check them out, and there's a lot more content there. David, thank you so much. I look forward to having a burger, but I think I'm going to avoid McDonald's and Burger King today, and because you said Five Guys, man,
Yeah.
and that made me hungry for a Five Guys burger, and I got one down the road. So I'm going to close this out, and I'm going to lunch.
All right. Enjoy Five Guys.
All right, David. Thank you so much. And thank you all for listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your coworkers. Thanks so much for listening today. For everyone at NREI, this is Eric Johnson inviting you back in 2 weeks for all the news that matters to you. And we'll see you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of NREI or Informa. The content has been made available for information and educational purposes only.